Imagine two people. The first person has spent years saving money. They skip unnecessary purchases, invest consistently, and slowly build their net worth. After nearly a decade of effort, they finally reach $100,000 invested. The second person starts with the same habits, but after reaching that milestone, something strange happens. Their wealth begins growing faster than before, even though they aren't working significantly harder. The difference isn't luck. It's mathematics. Many investors, entrepreneurs, and financial thinkers have described the first $100,000 as the hardest milestone in wealth. Because it is a magical number, but because it represents a turning point where the power of accumulated capital begins to work alongside human effort. Why does this happen? And why does reaching six figures often change the entire trajectory of a person's financial future? Wealth grows in stages. In the beginning, almost all progress comes from your labor. Your salary, your business income, your side projects, these are the engines pushing wealth forward. Your investments matter, but their impact is relatively small because the amount of capital invested is still small. If you invest $5,000 and earn 10%, you've made $500. Helpful, but not life-changing. At this stage, saving money often contributes more to wealth growth than investment returns. But eventually, a transition occurs. As your invested capital grows larger, the returns generated by that capital begin contributing meaningful amounts to your overall wealth. This is where momentum starts to appear. The game slowly shifts from earning money to owning assets that earn money. The first $100,000 often represents the point where that shift becomes visible. One reason this milestone feels so difficult is psychological. Human beings naturally seek immediate rewards. Saving money requires sacrificing present consumption for future benefits. That trade-off is difficult because the rewards initially seem small. A person might save hundreds of dollars each month and see only modest growth in their account balance. Progress appears slow. The effort feels disconnected from the reward. This creates frustration. Many people abandon long-term investing during this phase because they underestimate the cumulative effect of small actions repeated over time. Behavioral economists call this present bias. We tend to value immediate gratification more than future outcomes. The challenge of reaching $100,000 is not purely financial. It is often a battle against human psychology. The individuals who succeed are usually not those with perfect information. They are the ones who maintain consistent behavior long enough for compounding to become visible. Discipline survives where motivation fades, and consistency often matters more than brilliance. Let's examine the numbers. Suppose an investor earns an average annual return of 10%. When they have $10,000 invested, a 10% return generates $1,000. When they have $25,000 invested, the same return generates $2,500. At $50,000, it generates $5,000. At $100,000, it generates $10,000. Notice what happened. The investment strategy never changed. The rate of return never changed. Only the amount of capital changed. As capital grows, the same percentage produces increasingly larger dollar gains. This is the engine of compounding. Now imagine someone contributes $500 per month. Early on, their contributions represent the majority of their wealth growth. But as their portfolio expands, investment returns begin contributing more than monthly deposits. Eventually, the portfolio starts growing substantially from its own momentum. This doesn't mean effort becomes unnecessary. It means effort gains leverage. Every dollar saved in the early years becomes a worker generating additional dollars in future years. The larger the workforce of invested dollars becomes, the faster wealth tends to grow. This is why many investors describe the first $100,000 as the most difficult milestone. It often requires years of disciplined saving, patience, and delayed gratification before the mathematics begin producing noticeable acceleration. The significance of $100,000 extends beyond individual portfolios. It reflects a broader principle found throughout economics. Small systems often struggle with efficiency. Large systems frequently benefit from scale. Businesses experience this. Technologies experience this. Investment portfolios experience this. In the early stages of wealth building, every setback feels significant. Unexpected expenses can erase months of progress. Market declines feel painful because the portfolio lacks sufficient size to recover quickly through growth alone. But as assets accumulate, resilience increases. More opportunities become available. More flexibility emerges. More choices appear. Wealth is not simply money. It is optionality. The ability to make decisions without immediate financial pressure. The ability to wait for better opportunities. Accumulated capital expands those possibilities. The first $100,000 often represents the moment when wealth begins creating meaningful optionality. Not complete freedom, but increased flexibility. And flexibility itself has tremendous economic value. Perhaps the most overlooked aspect of reaching $100,000 is not financial. It is personal. The person who reaches six figures usually undergoes a transformation. They develop habits that many people never sustain long enough to acquire. They learn patience. They learn risk management. They learn delayed gratification. They learn emotional control during market volatility. Most importantly, they begin seeing themselves differently. Instead of viewing money solely as something to spend, they start viewing it as something that can produce future value. This identity shift changes behavior, and behavior ultimately drives financial outcomes. Many people assume wealth is created by a single breakthrough, a winning investment, a business success, a sudden opportunity. While those events certainly exist, long-term wealth is more often the result of repeated behaviors practiced over years. By the time someone reaches $100,000, they have usually built systems and habits capable of supporting even greater wealth in the future. The milestone is important because of what it represents. Not just accumulated money, accumulated capability. The first $100,000 is not a magic number. Crossing it does not guarantee financial independence. It does not eliminate risk. It does not solve every problem. But it often marks a fundamental transition. A point where saving becomes investing. A point where effort gains leverage. A point where capital begins working alongside labor. The journey to that milestone can feel slow. Progress may seem invisible for years. Yet beneath the surface, something important is happening. Every contribution, every investment, every disciplined decision adds another layer to a system designed to compound over time. Eventually, the results become impossible to ignore. The first $100,000 changes everything because it demonstrates a powerful truth. Wealth is rarely built in a moment. It is built through countless small decisions that accumulate, compound, and reinforce one another until momentum takes over. And once that momentum begins, the path ahead often looks very different from the path behind.